I'm Anthony Smith, and you're watching the Chart of the Week. Hello, and welcome to our weekly video. This week, we're going to explore what an inverted yield curve is. There have been lots of headlines this week alerting us to the fact that a segment of the Treasury yield curve inverted for a very brief moment on Tuesday. And this is big news because the shape of the yield curve is watched very closely by investors. And when it becomes inverted, many interpret that as a signal of an impending recession. So the rest of this video is going to be focused on describing a healthy yield curve and an inverted yield curve and why a yield curve might become inverted. What I don't intend to cover in this video is how reliable the yield curve is at predicting recessions. It is good, but it's not perfect, and I'd be more than happy to talk about that with you one-on-one offline if you'd like. All right, what is the yield curve in the first place? It is the yields on U.S. government bonds across the maturity spectrum from 1 month all the way out to 30 years. So let's look at a graphical representation of this. On the y-axis, you have yield or interest rates, and on the x-axis, you have the tenor or time to maturity. So ask yourselves, if you're going to lend to the government and you have a choice between locking your money up for 2 years or for 10 years, which one of those options should have a higher return on investment or a higher yield? And I would think that everyone would say the 10-year option should carry a higher return on investment or a higher yield. So the yield curve, this is the yield curve at year end. And this is just 3 months ago. And it had a positive slope, meaning that the longer investors or lenders, in this case, locked up their money, the higher the annual return, at least for the most part. You can see that beyond 20 years, it's pretty flat. All right, so an upward sloping yield curve like this would be considered healthy or normal. But as the headlines are screaming, the yield curve has inverted. So let's look at today's yield curve, and that is the green line on top. It definitely has a different shape, and I left the year-end yield curve on here just to show what has happened over the course of the first quarter. And it's not entirely inverted. In this case, the inversion that we're talking about is referring to the difference between the 2-year yield and the 10-year yield. So I will highlight those just to kind of show where we are focusing right now. There we go. The Fed has tremendous influence over what I call, or what is called, the front end of the curve. And I think of that as being anything out to 2 years in maturity. I don't think there's a formal definition of front end, but that's how I think about it. So it makes sense that the yield on the 2-year Treasury has shot up in the first quarter because expectations for Fed hikes have gone higher. So anything beyond 2 years in maturity, those bonds are more market-driven and incorporate expectations about future economic growth and future interest rates. So now that we're all on the same page about yield curves and what inversion looks like, let's move on to why inversion happens and why it's a scary indicator for the economic outlook. So if you think of what drives yields lower, it is investors demanding longer-term bonds. So like the 10-year Treasury, for example. All that buying, all that demand pushes prices up. And recall that as prices go up, yields go down. There's an inverse relationship there. So why would investor demand for longer-term bonds be so strong that it would push the yield on these bonds below that of shorter-term bonds like the 2-year Treasury? And there are a couple reasonable and related explanations. One is that investors expect a contracting economy to push alternative investments like stocks lower in price. And so they sell stocks, for example, and buy bonds. And that demand pushes prices up and yields down. Second explanation is that investors expect future interest rates to fall because the Fed will have to cut interest rates in order to boost the economy if there's a recession around the corner. So in this case, investors are essentially locking in the current long-term yields because they expect that future yields will fall. So they're locking those in. Again, all this buying puts downward pressure on yields out the curve. So that is how a yield curve becomes inverted, and that's why it's viewed as a warning sign for the economy. Thank you for watching. We'll see you in 2 weeks.